Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Monday. It's March 28th. I can't believe that April's almost here. It's like I'm still waiting for the winter, and I live in Florida, and there's hardly any winter, so it's a really confusing situation. But I guess the summer's almost here. Anyhow, this is the first day of the last week of March, and we are already primarily past March. We just got a few days left. It's about excuse me, I got cat hair in my mouth. Apologize. It's 7:40 in the morning. The market's going to open up in an hour and 50 minutes to be exact. And I guess the moral of the story is today, don't let cat hair get into your mouth. Anyway, let's talk about markets. All right, the NASDAQ and the Dow are up, which is actually kind of odd because Fridays and Mondays have been down days for the last couple of weeks, or actually more than that, about a month, since the market became increasingly anxious over the war with Ukraine. But looks like we're starting off on the right foot. Now, granted, 47 points up on the Dow is nothing because we've been seeing movements of 500 to 700 points, 600 points on the Dow per day. So anything positive or negative like this doesn't really mean much. But it is nice to see a pleasant start, especially after a weekend, and not much resolution with Ukraine. Now, the first thing I'd want to look at is the volatility index, which is just a hair up right now. But if you look here, it looks like we broke our major trend line and we are now going to the downside. Now, if we break this level right here, the 1991 level, if we break the 20 level, and we're very, very close, that means the market is not in fear zone. Anything above 20 on the VIX is a fearful level. We're already at 2149 and we're literally at the brink of World War III. So the market is reacting a lot better to what we're seeing right now than I would have expected in a million years. And that is because the Fed pumped so much money into this market and put so much liquidity into the global economy post-COVID. So in a way, in a crazy way, the reaction or what happened with COVID or post-COVID is actually really helping the market right now remain composed. Looking at the bond market, and I'll give you a quick look at the bond market here. Let's quickly take a look here. You could see here it's actually breaking lower, but it looks like it's not breaking lower too much. I'm hoping that price can get back into this box, or let me just kind of break that a little higher here. Break back into this box right here and away from these levels, because the lower we go on the bond market, the more pressure it's going to put on the stock market, because lower bonds equals higher interest rates, and higher interest rates, it's like a wet blanket for the stock market. But as you can see here, it doesn't look like we were going down too much. I mean, we went from 131 to 129 in 2 weeks, so it's not too much. It's definitely not this kind of a bleed. But I would like to see the bond market get back to the 140-ish level, where I would like to short it, because ultimately interest rates are going to go higher. But I think this is too much too soon. Going from 140 to 130 in, let's see here, less than 3 weeks? That's just too much too fast. And I think the bond market's going to react by moving higher, especially if there's a relief with the war that we're seeing right now. Now, if you're looking at the major sectors on a 1-month basis, you still have energy, utilities, basic material, and industrial lead, which makes perfect sense to me. These are the most defensive and war-friendly assets. But look at consumer discretionary. I mean, consumer discretionary should be down here. Information technology should be down here. Instead, you've got consumer staples here, which makes no sense whatsoever. It's almost possibly because the war is making the basic material and industrial stocks so expensive that consumer staples are coming all the way down here, but still, it makes no sense. You would think consumer staples would be up here. Consumer discretionary is beating consumer staples. That makes no sense at all on any kind of level, especially when you have 3 defensive sectors leading. Now, on a 5-day basis, things are not all that much better. Consumer discretionary is here. Consumer staples is leading ahead recently, but look at information technology. So you still have energy, materials, utilities. On a 5-day basis, things are getting a little more interesting. On a 1-day basis, on Friday's basis, consumer discretionary is still low, but the market is moving higher. So to say that the market is fragmented right now would be the biggest understatement. As far as the CSI scan, energy, utilities, basic materials, financial, and industrial. And I'm going to tell you right now, this looks right to me. I don't know if I'd put financial instead of ahead of industrial. I think I would put industrial right next to basic materials, which I think ultimately it's where it's going to end up. But again, material is response first, then industrial, because industrial is what you do with the basic material. So all in all, these sectors, energy, utilities, material, financial, and industrial, they're the leading ones right now. And consumer discretionary and technology are still on the toilet. I'm still surprised that consumer staples is kind of not here nor there. Now, if we look at the charts, and it's important to look at the charts to see what's going on. Energy looks like it's, again, starting to make a run for all-time highs. Not a surprise. I told you guys utilities are going to be expensive and stay in this area, and it's impossible to see a run-up like this in energy and not see utilities get more expensive, right? Basic materials, folks, I think about how much money is going to go into rebuilding Ukraine. And we're right near our resistance level. I think we may head just a hair higher and then back away. It's just too much too fast. These parabolic, remember, the market is mean reverting. The stock market, not the bond market, not the currencies. Stocks are mean reverting. So anytime you see a move too much too fast, typically it pulls back. So don't be surprised to see a pullback, especially with the market a little higher today. The energy sector is looking, the financial sector is looking good. And it looks like we have a little consolidation here versus a pure run-up like that. And I like the financials a lot. I've been saying that a while. I like the industrial because, again, they're having a nice little consolidation before moving up, whereas materials are just going crazy. But it kind of makes sense in light of what we're seeing right now. Healthcare looks like it can go up for another round. Consumer staples looks like they'll go up to the 76 level. Real estate looks like it's choppy right now. Communication sector, I think, is going to cool off. I think technology is going to cool off, and consumer discretionary is going to stay choppy and start creating a base, because I think the bullishness may start coming into it. If not, we're going to go back down to its base. Bottom line, I think we're a little bit overbought at these levels. Looking at the main index, looking at the SPY, let me give you some major levels. And if we don't break these levels, we're going to start coming lower. We're above the 50-day, the 200-day moving average. We're above the 50-day line, even though the 50-day line is below the 200-day line, so it doesn't really say anything on that in that respect. We now have 2 days of bullishness, and I like where we're at right now. I want to see us break above the 458.84 level. If we can break above this level, we're looking really good. There's a level on consumer discretionary that I've been targeting. It's still kind of quite up. It's right here, 191. If we can break this level, we're going to go up. There's a lot of shorts around here. Still have some more to go till we break the 200-day line. Looking at the QQQ, I think we're getting closer. We're getting just edging closer and closer. We're right at that resistance level right here. It looks like we're breaking higher. Would love to see us break above. Looking at semiconductors, though, let me show you this. They're already above the 200-day line. And looking at the Dow Jones, we're almost there. So the question is going to be, are we going to break this level, or are we going to bounce through this level? The next few days are going to be crucial. There's a lot of stops right here. So there's a good chance we're either going to just cover around here and then just come back down, although that's not as likely because the uptrend has been getting higher. Or we're going to continue breaking above this like what we're seeing on the SPY. It's very, very hard to say what's going to happen because the war is driving this market right now in the short term. But let me show you. We've got earnings starting this week. Tomorrow we've got Micron reporting. Big report. On Wednesday we've got GDP, which is the biggest report of the quarter, and it's going to give us a good idea of how much we've grown, especially in light of this war that's been going on for a third of the GDP. But that's the big report of the week. Consumer confidence is a huge report that's coming out tomorrow. That'll reflect on the GDP. And finally, the Fed answered my prayers. We're seeing a report that's going to help us decide what the GDP will be before the GDP, not after the GDP. But those are the big reports for the week: consumer confidence and GDP. Everything else is secondary. Personal income and jobless claims are always important, but I think these are fairly solid right now. ISM manufacturer and employment situations are always big, but I'm going to tell you, GDP is the biggest. GDP and FOMC are the biggest reports of the quarter, and this will give us a good indication of how much we've grown, and it'll tell us whether the bond market should be moving higher or lower and it's going to reflect on consumer discretionary, which is 2/3 of the GDP. So it's going to be a very important week in light of the potential meeting they're going to have between Ukraine and Russia. The GDP, keep your eye on the SPY on these levels. More importantly, keep your eye on those levels on the Dow and the NASDAQ. On the Dow, that level is 351 or 350-ish. And on the QQQ, that level is 368. Not sure if we're going to break above that level. Would love to see it. I think the GDP is going to be very important. I think the consumer confidence is going to be very important. Keep your eye on the bond market. If they start moving higher, if the bond market starts moving higher, that means the stock market is getting a little bit of relief, okay? So the bond market's very instrumental. Keep your eye on the defensive sectors versus the speculative sectors to see which ones are going to win the battle this week. Now, before I let you go, and again, we're going to have earnings this week. We're starting slowly, but tomorrow I think we're having earnings on Lululemon and Micron. Lululemon is going to give us a really good taste of what's going on with consumer discretionary, and Micron is going to give us a really good taster of what's going on with the broader QQQ and tech. So you do not want to miss out. This week is going to be big. Now, before I let you go, between Russia and Ukraine war, rising interest rates, ramping inflation, and skyrocketing gas prices, folks, we've seen the stock market whipsaw accounts day in and day out since October now. That's why former hedge fund manager Jeff Zananeri, he's sharing a special strategy on Tuesday. Now, listen, there's been no directional bias of late in these markets. And sadly, we're sure a lot of people have seen their gains from the past 2 years ripped away in a matter of weeks. Folks, click on the link below. Click that link below now to learn about Jeff's headers and reveal how it works to the public. It's happening today. You don't want to miss out. Follow the link below. Actually, I don't think it's happening today. It's happening this week. You don't want to miss out. Follow the link below. And tomorrow, strongest sector, strongest stock, weakest sector, weakest stock. Follow the link below if you're watching on the Wealth Press YouTube channel. It should be in the descriptor, the link that I'm talking about. And send me some love letters. I haven't heard from you in a while. Bye, guys. Have a great, great day.